Happy Friday. Happy Freedom Friday. We're really going to try to get you guys to financial freedom. And there's no better way to do it than investing. And I always get asked this question, what is investing, or how do I invest, or, what are some of the things to look for in investing? And, I said, those are excellent questions. And a lot of times, those type of questions aren't really answered. And it's important to at least have a foundation, because you don't want to repeat of, the Bitcoin type of fads where you're following someone else just because, hey, you don't have enough information to make decisions on your own. So guess what? You follow the crowd, or you follow the herd right to the slaughterhouse. So it's good to have that foundation so you can make those critical judgment on your own to help get you to financial freedom, right? So investing one-on-one, that's what we're going to talk about. And I kind of came up with this this equation, if you will. And listen, this cuts across all asset classes, not just it includes stock market, real estate market, bond market. I don't care if you're buying the mom and pop corner store. This foundation is going to be really key for you to help determine whether or not you're buying not only a good product, but more importantly, paying a fair price for it. Okay, so this is how the equation works. First, you start with historical financial data, or historical data on the operations of the particular asset class or business that you're looking to acquire, which is easy to get, right? You should be able to get that information, even if it's not a publicly traded stock that you're buying, even if it's a private company or you're buying real estate, you should be able to get historical data. Okay, if you can't get historical data, then it's probably not something that's worth your time in pursuing. Okay, you're going to mix that historical data, the past data, with current information. Okay, you're going to add current information. When I mean information, I mean still talking financial, still talking operations of that particular asset class. You're going to combine it with the future events or future projections of that particular asset class. Now, keep in mind that when you do bring in future events, or if you're trying to project out into the future, like if you're buying real estate and you're saying, hey, I believe I can get these rents up about 3% for the next 5 years, that's a future event. Now, we don't have any crystal balls. Last time I checked, Jesus is on the right-hand side of God. So unless he gave you a vision, we can't tell the future. So with that being said, that's going to introduce risk into your investment theses now, right? Because we got historical, no problem. Current event, not a problem. But that future data, or that future events, like political events, for instance, who's going to be the president in 2020, like things that type of information could have an effect on that particular asset class. So risk gets involved, and we'll talk about these two charts down here later in the video. But again, with projecting out into the future, that's going to introduce risk. Okay, so that's part of the equation. So you're going to have your historical, current, future, and you're going to add that to the investor psyche, or the investor mindset. Now, this is where things kind of get dicey, as well as risk. Things get dicey as well, but this gets dicey for a couple of reasons. Number one, it's hard to quantify. Right? How I think and how the next person thinks could be totally different. So it's almost, you got to trust your gut. There is some data out there, but you also got to trust your gut. But I want to talk about the two critical things. There are a lot of things that can go into the investor mindset, but when we're talking investing, there are two critical items that really drive the investor psyche. Number one is the availability of credit. And in this video, we're credit and how the world works today. Credit equals money. Okay, it's not just the cash that you have in your pocket. If you can go to a bank and get a loan, it's going to be credit to the bank, it's going to be debt to you, but that is considered money. Matter of fact, there's more credit and / debt in the economy than any other form of money. So credit is huge. Okay, and it starts with the Federal Reserve. It's like turning a faucet on and off. When they turn that water faucet on and credit is abundance, it's going to lower the cost of capital. Okay, which is going to be great for the business or the end consumer, because it's not going to cost you as much to borrow the money. But What that does is two things. One, it's going to increase the investor mindset from a wealth effect standpoint. Okay, if there's more credit or more money supply in the system, companies can hire more people, right? Because they have more money. They can go out and invest in R&D and equipment and people and all that. So jobs are plentiful. Okay, that's going to push real estate up, right? That's going to push the stock market up. Things inflate when you have more money in the system. Asset prices rise. So that may not be the best time to try to buy or invest in assets because you're almost at a peak, right? Credit is abundance. The investor mindset goes up. Wealth effect is in full play. Asset prices rise. Okay. The second thing that affects the investor mindset is interest rates, and those are pretty closely tied to the credit. It's like this: if you go to borrow, you go to take out a mortgage, right? You're going to buy a house to live in, and you're taking out a mortgage, and your income doesn't change. Let's just say you make that, you make $100,000, which is, the income everyone uses. You make $100,000 a year before taxes, and so your income doesn't change. But what could change the amount of money that you're able to borrow to get your house? The interest rate, the cost of capital. Okay, how much is it going to cost me to borrow this money? When interest rates are lower, the cost of capital goes down. You could borrow more money. And that ties to credit. That's going to go to the investor mindset. Asset prices go up. When the cost of capital, interest rates rise, okay, less people are in the market to borrow money. When there's less people in the market to borrow money, there's less people to buy your assets. Asset prices go down. So when credit gets turned off, when the Fed says, okay, enough's enough, there's too much money in the system, we're going to scale back. Okay, the big banks scale back. The regional banks scale back. So it's a domino effect. Okay, and when that money gets dried out, there's no more money in the system. The Great Depression, there's no more money in the system. Now, I'm not saying it's going to be, drastic like that, but that does have an adverse effect on asset prices. They will decrease. When the reverse happens, there's plenty of credit, interest rates are low, asset prices go up. So that leads me to our two charts here. I always forget y-axis, x-axis, whatever. You have your return access, and then you have your risk access, your risk line or whatever. I call this the risk curve. Okay, so on the risk curve, you have different asset classes. Okay, now there's also something called the risk premium, which is basically a spread between how much risk you're willing to take on for a higher return. Now, it all starts with the treasury bonds because that's believed to be a risk-free asset class, meaning treasury bonds are issued by the United States of America government, and everyone in the world feels that the United States cannot default on their loans. We all know that's not the case. They can default, but we believe as a people that the United States will honor their commitments. So the treasury bonds, so you can, there's the 2 years and 5 year. I think there's even shorter terms in the 2 year, 5 year, 10 year, 30 year. Those are the big ones there. And so there's no risk there. So every other asset class after the treasury bond has a risk premium. How much more risk am I willing to take over me just not giving the United States government my money and saying, hey, just pay me an interest rate? Well, when those interest rates go lower, then people start to chase yield. And that's where this particular curve starts to flatten. So now people are willing to take more risk for less return. When that happens, this is what you call a hot economy. Asset prices are rising, you don't want to buy because you're going to be buying at the top. Okay, but when this risk curve is steepening, meaning people are if I'm going to take on risk, say, and let's just say this is the 10-year here. Okay, then you have corporate AAA bonds like an Apple, right? A big company that no one thinks is going to default. Their bonds are going to be, considered less riskier as well. Then you have junk bonds that get a little bit more riskier. Then you have common stocks and you have real estate and all these other assets. So as you get further along this curve here, you're saying as an investor, okay, I'm going to invest in these asset classes, but I better be getting a bigger yield because there's more risk. right? I might as well just go out here and buy a 30-year treasury bond. Yeah, I might not get much yield, but guess what? I don't have any risk of capital. My capital is going to be protected. I don't have any risk of losing my capital. But so this is in a bad economy. That risk curve starts to steepen and people start to get more risk averse. People are more risk tolerant here. So when this happens, you got the investor mindset is going up. There's more credit in the system. Interest rates are going down. Asset prices get inflated. You don't want to buy there. You want to wait till the investor mindset goes down. There's not a lot of credit in the system. Therefore, there's no borrowing. The money supply shrinks up. Asset prices go down. And that's when you want to invest. Okay, we know this stuff. Come invest with us today, New Level Realty. If you have questions, give us a call, and we'll love to work with you. Thanks for watching. Freedom Fridays. Go get them.